Tell me about what Larry Fink just said. Did you hear that intro? He said there's been a stampede into fixed income. Still not that much excitement or enthusiasm about stocks. Is that something that in your work you've seen, or do you have a different view?
No, I think Larry's right. And what's caused this has been the Fed changing courses and saying we're going to leave interest rates the way they are right now. And also, if you look at the other central banks of the world, the Bank of Japan, the Bank of China, the Swiss Central Bank, you're at 19.4 trillion of money created out of nothing but thin air. And when you equate this, so you understand how important this is, in the United States, we're running at about an 8% free cash flow for a $22 trillion economy. This 19.4 trillion is a totally free cash flow, and that equates to about $230 trillion. And so we're seeing a big change. What the Fed did in December was a disaster, and we're seeing a huge change of attitude in the Fed.
We seem to have bounced, I'm talking about yields. The 10-year bounced off of like the low 240s. I don't know if we got under 240. Are we done with the test of those really low yields, Mark? We're back to 250. No?
No, we're not. And I'll tell you why, in my opinion, Joe. You know, right now, when you look at the world, so this is a little global view here, every country in Europe, including Greece, Portugal, Spain, every country in Europe, if you look at the 5-year Treasury versus their yields, we have higher yields, and we're the biggest economy on earth. We have the biggest bond market, and we have higher yields in all of those countries, and including Japan. And consequently, I think we're just at the beginning of a cycle where interest rates go even lower. And then the other thing I would point to is that the corporate bond index, like the corporate bond index and the high yield bond index, are even up more than the government bond index, which means that you're seeing compression in terms of riskier assets. And I see this continuing for many, many years.
I wonder what all that says about the relative valuation of stocks, since multiples are based on interest rates, and whether there's any alternatives. But it also doesn't sound like you have a rip-roaring global growth forecast either, if it stays low. Or maybe it's based on inflation, not growth.
No, I do have a positive outlook on growth, and I have a positive outlook on the equity markets. And I will tell you why, because these lower borrowing costs, and Trump is right about this, in my humble opinion, it's not a political comment, but the lower the borrowing costs, the better it is for the economy and the better it is for the market. And I see us heading to even lower rates. The ECB right now is in lending money cheaply to their banks. Japan's central bank has a balance sheet that's equivalent to their entire GDP. And I just see this continuing because you can't withdraw this money without causing a major infraction in the markets. And so it's going to just keep continuing, which is why I think we have a radical alteration. It used to be, I've been on Wall Street 45 years, it used to be that the central banks were a major part of the game. My opinion, Joe, now is that the central banks are all of the game. They represent everything that's going to happen, basically. I mean, you're going to have individual companies that go this way and that way, but with lower borrowing costs, it means that refinancings are possible. It means that high-yield bonds, new offerings are at much lower rates. And I think the Fed has done a backflip and reverse course that's not going to change.